So is it finally time to short the S&P 500 and to bet on a bigger decline from current levels? Well, Bank of America seems to think so. So in this article that came out on the 11th of April, it says Bank of America is advising that investors short the S&P 500. Now, for those of you who don't know, to short is to short sell, which is to bet against the market. So if the market goes down, you make a lot of money. If the market goes up, you lose a lot of money. So their chief investment strategist, Michael Harnett, said the US is moving away from the world's main buyer of goods and the go-to place for global investments. And he called this shift the end of US exceptionalism and the start of a US rejection period. So get out, sell everything. So should we listen to this advice? Let's find out in this video. Now, before I analyze the markets and to see if it's a good time to short the markets, always remember that in the long run, the stock market will always go up in the long run, because in the long run, corporate earnings will always grow at about 8%. You add in share buybacks and dividends and money supply, you get about 10% return a year over the long run. But in the short term, remember that no one can predict the direction of the market with 100% certainty, because anything can happen and there are too many moving parts. So any kind of short-term prediction is really based on probability, and there's no 100%. So if you do want to short the markets after this video, remember to always have a stop loss, because if you don't short with a stop loss, your loss is unlimited. Okay, so let's get down to it. So let's take a look at a few things. The first thing is let's take a look at the technical chart patterns. And by the way, for those of you who think that the S&P 500 is in a bear market, it is not in a bear market. Well, at least not yet. Now remember, the definition of a bear market is when the price drops and closes 20% from the high of the market. So what happened to the S&P 500 was it got very close to a bear market. So on this day, it actually dropped over 20%, but by the end of the day, it closed above 20%. So since then, it's not closed below 20%. So technically, the S&P 500 is still in a bull market. Now, having said that, the technical patterns show that the market is in a confirmed downtrend, both in the short-term frame and the medium-term frame. So you can see over here, the 20 EMA, which is the red thin line, is below the 40 EMA, the blue thin line. So that signals that, yeah, we are in a downtrend. As you can see, a wave up, a wave down, wave up, wave down, and now wave up. So it is making lower highs and making lower lows. So we are in a downtrend. Now at the same time, you can see the 50 moving average in blue, the thick blue line has crossed below the 150 moving average, signaling a medium-term downtrend. As some of you would know that when the 50 crosses below the 200, they say that, oh, that is a death cross. So technically, yeah, we are in a downtrend. And remember that in a downtrend, prices don't drop in a straight line. They still move in wave patterns. Wave down, wave up, wave down, wave up, wave down. So you can see that it has formed that pattern, right? We've got a first wave down, and then we've got a wave up that found resistance at the 200-day moving average, wave down again, then wave up, found resistance at the 20 EMA, then wave down, and now wave up. And right now you can see that the candle that just closed yesterday closed below the 20 EMA. So based on technical patterns, you can see that there is a level of resistance at the 20 EMA. So that's the first level of resistance. So for people who think that, the downtrend is in force, then yeah, this could be a good place to short the market, where you could place an order to short the market if the price breaks below the low of this candle, but to put a stop loss above that swing high. So this could be a possible short entry. And again, whenever you want to short a stock or short the market, you place a stop loss, you calculate the risk to reward ratio so that if the market goes up, here's the stop loss, you lose 1R, but if it goes down, you can make 2R, 3R, right? So I wouldn't say that this is completely a bad trade. It is a reasonable short trade if you're thinking the downtrend is going to continue. Now at the same time, you also notice that if you connect this swing high to this swing high, this is also a level of resistance. So if it breaks above this level, which is the 20 EMA, then it could find this trend line resistance before it comes down again if you think the downtrend is going to continue. All right, so I think basically that is the short thesis from a technical perspective. But as you know, when you analyze the markets, you have to look at two sides of the coin. Okay, so that's the bearish thesis technically. How about the more bullish thesis? And at the end, you judge which is stronger. Now, if you take a look, on the other hand, at the higher time frame, which are the weekly candles, it tells you a slightly more bullish picture. On the weekly time frame, you can see that this was a major swing low that was made somewhere in August. And right now, we have got the market going down and going below this recent swing low and closing back above that swing low with a strong bullish candle. This is what we call a bear trap. It's also called a false bottom, as my buddy Elson Chu likes to call it, or simply a false double bottom pattern. So this is actually quite a bullish signal on the weekly candles, right? So based on this, we may see a rebound back up there based on the weekly candle. So sometimes the daily time frame could be bearish, but the weekly time frame could be bullish. I say, which one do I listen to? Okay. Well, generally the higher time frame patterns are stronger than the lower time frame patterns. Reason to be bearish, 1. Reason to be bullish, 1. So from a technical perspective, I would say that it's still a 50-50 of where the market's going to go in the short term. However, let's take a look at something which I think is more powerful. If you listen to the interview by Treasury Secretary Scott Bessent in the last, I think it was yesterday or the day before, he gave a very interesting clue about where he thinks the market is going to go in the short term. Now, you may say, why should I listen to him? Well, first of all, he's a Treasury Secretary, which is no big deal, all right? But I think what's a bigger deal that Scott Bessent is probably one of the smartest guys in finance in the administration. So for those of you who don't know, he used to be a hedge fund manager who worked together with George Soros, and they made billions of dollars shorting the British pound back in the 1980s. So he's one of the few Treasury Secretaries that's not really an academic, but he's a practitioner in terms of the market. So it is worth at least listening to what he says. So this is what he said in a recent interview. He said, if we measure the uncertainty of the market by the VIX is the volatility index. I don't want to make market calls, that's what he says, but it seems the VIX has spiked and likely peaked. So what he's saying is that I don't want to make a market call, but he's making a market call, okay? Now, if you read between the lines, what he's trying to tell you is that the market has already bottomed. Now, again, can we completely trust them? Of course not. They may have an agenda, right? But let me talk a bit about why I find this very interesting. Now, if you don't know, the VIX is known as the volatility index, and it's also known as the fear index. So when people are scared, when there's a lot of fear, the VIX goes up. So when the VIX is very high, it's a measure of extreme fear. When the VIX goes down, it means people are no longer fearful. Now, you will notice a very interesting pattern in the markets of how the market bottoms correlate with VIX movements. Let's take a look. Now, last week, the VIX went above 60. Now, let me show you this chart. This chart that you see over here, this is the VIX, the volatility index. And you can see this is the 60 level. Watch this level, very important, the 60 level, and watch the 35 level. And I'll explain why in a short while. So like I said, last week, the VIX went above 60. And that signifies extreme fear. People were scared shitless. Now, it's very rare that the VIX goes above 60. In fact, in the last 35 years, since 1990, the VIX has only gone above 60 3 times, excluding this time. So total 4 times, right? So you can see that the one time it went above 60, just before this, was last year, August 2024, during the Japanese stock market crash. Went above 60. During COVID, the COVID pandemic, people were scared shitless. It went above 60. During the great financial crisis of 2008, 2009, it went above 60. Now, what's interesting is during the dot-com crash in 2000, the VIX did not go above 60. In fact, it didn't even come close to going above 60, but it did go above 45. Right, so that tells you that in the old days, people had bigger balls than they do have today. We are a bunch of pussies today, okay? Now, I may say, so why is this important? Because I found an interesting pattern. Then wherever the VIX goes above 60 and then drops below 35, it usually signals the bottom of the crash. Let me show you what I'm talking about. So first of all, you can see that the chart below, this is the S&P 500, and the chart above, that is the VIX. So let's go back to the great financial crisis of 2008, 2009. So you can see that this was the financial crisis. The market went into a bear market over here, and then it bottomed here. There was the bottom, and then the bull market started. So you can see that when the market was going down, people were losing their shit. Right? They were all scared shitless, right? And what happened to the VIX? You can see that the VIX went above 60 right there. Okay, went above 60, people were like scared shitless. Now again, what's important is to watch when it drops below 35. 35 is a magic number. So you can see that, right, it and then it dropped below 35 right here. Can you see that? Okay, and if you bought there, that would have been buying right near the bottom. Okay, now, and then it dropped below 35 again here. And by that time, the market would have already gone up quite a bit, but you would still have gotten in early in the bull market. So that was the GFC of 2009. Now, the next instance when the VIX went above 60 was COVID. That happened 5 years ago, if you recall. So again, with the COVID crash, right, people losing their shit again. And then we got the VIX, the fear index, measuring fear and panic, went above 60. Again, very rare, happened only 4 times in the last 35 years, including this time. But again, what's the magic number? Magic number is drops below 35. So when did it drop below 35? It dropped below 35 actually right there this week, right? And if you entered there, you would have entered here, not exactly at the bottom, but you would have gotten in again early enough to ride the new bull market over there. So that was 2020. And then let's look at 2024, moving closer to where we are today, which was the Japanese black market crash caused by the unwinding of the yen carry trade. This happened August last year. Now bear in mind, I'm looking at weekly candles. These are weekly candles, and you can see that for a very brief moment, what happened? Yup, the VIX spiked up, went above 60, extreme fear, and then within that same week, it dropped back below 35, and that again signaled the bottom of the S&P 500. If you got in right there, you would have rode the bull market all the way back up. So where are we now? So right now we are here, right? The market has dropped this year, 2025, and the VIX has spiked up to just above 60. And guess what? Have we gone below 35? Yes, we have. We have just dropped below 35. And this is what Scott Bessent was probably talking about, that he says the VIX has peaked and his hint is the market has bottomed. So again, is this a guarantee 100% go all in? No, there are no guarantees in the market. In the short term, anything can happen. This is just a probability. But I think it's a pretty good probability. Okay, so if you ask me to short the market, I'll think twice. Okay, now, how about, let me show you the dot-com crash in 2001. Now, like I said, during the dot-com crash, that was a bear market, but the VIX never went above 60. Don't ask me why. I guess people were not as scared that time. They were like, don't worry, we're okay, right? So let's take a look at that. So this was, again, the bear market of 2001, 2002. And again, if you look at the VIX, it did not go above 60, but it did go above 45, which is quite scared still, all right? 60 is scared shitless, 45 is scared with a bit of shit left, right? So you can see that it went above 45 right there. Can you see that? Right there, it went above 45. And again, same rule. We want to get in when it drops below 35. So went above 45 and it dropped below 35 right here. Okay. And lo and behold, that was somewhere here. Now, was it exactly at the bottom of the market? No. We can't always buy right at the bottom, but as long as we buy, near the bottom, plus or minus a few, 5-10%, is pretty good, right? So if you got in there, you may have seen like a bit of a double bottom pattern, but then you have gotten in way before the huge bull run took the market higher. So once again, in the short term, no one can predict for sure where the market is going. There are too many unknown variables. You don't know what Xi or Trump's going to say the next day. But we look at probabilities. We look at technical patterns. We look at the VIX and look at all kinds of stuff. And by looking at all kinds of stuff, am I 100% convinced that I'm going to short the market? Not really, right? So in fact, if anything, I'm still leaning slightly bullish in the short term. But of course, in the long run, I'm always bullish. People say, Adam, you're a perma bull. Yes, thank you. I am a perma bull because I know in the long run, the market always goes up. And remember that if you're not too interested in, trading the short term, you can ignore everything I just said and just buy good companies that are at a discount. And that's what I did. The last couple of days, in fact, last week, added to my Nvidia, I added to Meta, I added to Microsoft, I bought more MasterCard, I bought more S&P Global, and I added some new stocks like IDEX Laboratory. So I use this as an opportunity to add more shares of high quality companies. And even if it does go down a bit more, who the hell cares, right? Long run, it always goes up. So, people always tell me, Adam, I will only buy stocks when there are no problems in the world, when all the crises are resolved. Now, will that ever happen? Okay. Will your life ever have no problems? Yes, it's called death. The day you're in the graveyard, you got no more problems. As long as you're alive, you will always have problems. Same thing in the stock market. The stock market will always have a crisis it's worried about. There's always something to worry about. And there's always a smart reason people tell you to sell or short the market. But as I always say, macroeconomic or geopolitical factors should never be a reason to sell the market. And in the words of the great Peter Lynch, he said, your ultimate success or failure to build wealth will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. If you take a look at this 15-year period when the S&P 500 gained 830%. 830%. But most people would not have been able to compound their wealth at 800%. Why? Because there were so many reasons to sell. There were so many things to be scared of. If you take a look at all these, crises that happen, whether S&P downgrades US debt, or Ebola virus, or US government shutdown, or there's an earnings recession, or you have got the yield curve inversion over there, you've got the COVID pandemic, you have the storming of the US Capitol, you've got a Delta variant, you've got Omicron variant, Russian invasion of Ukraine, S&P enters a bear market here, US inflation hits a 40-year high, collapse of Silicon Valley Bank, you've got China Evergrande Group collapsing, US national debt tops 35 trillion, you've got a Samru recession indicator triggered. If you read all this news, you'll be scared out of the markets and you'll never have the chance to compound your wealth. All right. So think long term, but in the short term, again, if you want to trade, that's great. Have a stop loss in place, have profit targets in place, but only take high probability trades. Thank you for listening, and I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.